Your credit score determines the interest rate you pay on every car loan, mortgage, and personal loan for the rest of your life. A 50-point difference in score can add $40,000 to the total cost of a 30-year mortgage. Most people have no idea how the score is calculated, or that they could raise it 50 points in 6 months with changes that cost nothing. This video is the complete guide to credit scores, how they're calculated, the 5 factors that control your number, what actually works to raise it, and what doesn't, including the common advice that wastes your time. How credit scores are calculated. FICO scores, the version most lenders use, are calculated from 5 factors, each with a specific weight. Payment history, 35%. Whether you pay on time. A single 30-day late payment can drop your score 50,100 points and stays on your report for 7 years. This is the most important factor. Credit utilization, 30%. How much of your available credit you're using. If you have $10,000 in credit limits and $3,000 in balances, your utilization is 30%. Below 30% is the target. Below 10% is better. This factor responds quickly to changes, within a billing cycle. Length of credit history, 15%. The average age of your accounts. Older is better. This is why closing old credit cards hurts your score. It shortens your average history. Credit mix, 10%. Having both revolving, credit cards, and installment, loans, mortgage, credit. Minor factor, don't open loans just to improve this. New credit inquiries, 10%. Hard inquiries from applications for new credit. Each hard inquiry costs a few points temporarily. Multiple inquiries in a short window for the same type of loan, auto mortgage, are counted as one. What moves your score most in 6 months? The 2 highest impact actions are payment history and utilization. Combined, they're 65% of your score. On payment history, if you have any missed payments, they'll age off eventually. You can't remove them early if they're accurate. Focus on having no new late payments. Automate the minimums on every account, so a forgotten payment never costs you 50 points. On utilization, this is where most people have the fastest leverage. If you have credit card balances, paying them down directly raises your score. If you have $3,000 on a $10,000 limit, 30%, paying it to $1,000, 10%, typically adds 50 points within one billing cycle. If you can't pay down balances, request a credit limit increase from your card issuer. If your limit goes from $5,000 to $8,000 and your balance stays at $2,000, your utilization drops from 40% to 25%. No money spent. The increase request takes 5 minutes online. It works if your account is in good standing. What doesn't work? Closing old credit cards, counterproductive. Closing a card removes available credit, raises utilization, and eventually shortens your credit history. Keep old cards open unless the annual fee isn't worth it. Opening new cards to improve credit mix. The inquiry and average account age impact usually outweigh the mix benefits short term. Only open new accounts when you need them. Credit repair companies. There's nothing a legitimate credit repair company can do that you can't do yourself. They cannot legally remove accurate negative information. What they can do, disputing errors, you can do for free. If you see errors on your report, dispute them directly with each bureau at annualcreditreport.com. Checking your own score does nothing to your score. Checking your own credit is a soft inquiry. Only applications for credit cause hard inquiries, the score tiers and what they cost. Understanding what your number means in practice. Exceptional, 800-850, lowest available interest rates on everything. Very good, 740-7999, nearly as favorable. Little difference from exceptional. Good, 670-739, approved for most loans, slightly higher rates. Fair, 580-669, approved but higher rates often requires larger down payments. Poor, below 580, Limited approval options, very high rates. The difference between $620 and $760 on a $350,000 30-year mortgage at current rates. $620, approximately 7.8% rate. $2,512 a month, $554,000 in total. $760, approximately 6.8% rate. $2,286 a month, $423,000 total. $131,000 difference on the same house. For the same person. The only variable is the credit score. 6 months to a better score. Step 1. Get your actual credit reports. Go to annualcreditreport.com, the legitimate free one. Download all 3. Equifax, Experian, TransUnion. Look for errors. Accounts you don't recognize, incorrect late payments, wrong balances. Step 2. Dispute any errors you find. Online dispute at each bureau. Errors must be investigated within 30 days. Accurate corrections raise your score. Step 3. Automate every account's minimum payment. One missed payment is the single most damaging thing. Automation prevents it. Step 4. Identify your highest utilization credit card. Put extra money there first. Even $200 of paydown on a maxed card can add 20 to 30 points. Step 5. Do not open new accounts unless necessary. Let your existing accounts age. Follow those 5 steps for 6 months. Most people in the 620-700 range can reach 720, 760 in that time, enough to cross into the tier that makes a material difference on loan rates. If you want to know how to handle debt that's showing on your credit report from an old collection account, what to do, what to negotiate, and what to leave alone, that guide is linked here. And if you want to know the exact order to pay off multiple debts to get the fastest credit score improvement while minimizing interest, the Debt Avalanche comparison is linked here.